This lecture is over options and corporate finance. I'm your professor, Dr. Stephen Haggard. An option is the right but not the obligation to do something. For instance, when you are accepted into the Missouri State University MBA program, that gave you the right but not the obligation to attend. When we talk about financial options, we're talking about the holder of the option having the right but not the obligation to buy or sell a given quantity of an asset on or before a given date at prices agreed upon today. Now, that on or before is going to differ whether or not you've got a European option or an American option. A European option only allows you to do the buying or selling on the given date, but an American style option allows you to buy or sell at any time up to and including the given date. When we say that you are exercising the option, that's the act of buying or selling the underlying asset. In other words, it's the act of doing the thing that the option gives you the right to do. We have what we call the strike price or exercise price of the option. That's that price that's agreed upon today to act upon in the future that we mentioned in the definition of an option. And finally we have expiry. Expiry is a British term. It simply means the expiration date. That's the maturity date of the option. After that date, the option has no value whatsoever. As mentioned previously, European options and American options are different. European options can only be exercised at expiry, in other words, only on the expiration date. However, American options can be exercised at any time up to expiry. But we're going to show you in this lecture that it is seldom optimal to exercise an option early. You'd be better off to sell the option than to exercise it. The names American and European refer to the style of the option, not necessarily the location of its origin. For instance, you could buy a European option in America and you could buy an American option in Europe. This simply refers to when the option can be exercised, not to its region of origin. Here's some more vocabulary. We say that the option is in the money if exercising the option would result in a positive payoff. We say the option is at the money if exercising the option would result in a zero payoff. In other words, where the exercise price was equal to the spot price of the stock. The spot price is just the current price that you could buy it for in the market. And we say an option is out of the money if exercising the option would result in a negative payoff. Now we're going to talk about some different types of options. A call option gives the holder the right, but not the obligation, to buy a given quantity of some asset on or before some time in the future, also known as expiry, at prices agreed upon today. That price that we agree upon today is called the strike price. And so when you exercise a call option, you are basically forcing the other person to sell it to you. Students often get confused and say that both sides of an options transaction have the right but not the obligation. That can't be. The seller has to have an obligation in order for the buyer to have the right. When you exercise a call option, it's called calling in the asset. And if you were the one that sold the option, you would say, I got called out. If the buyer of the call option exercised their right and forced you to sell the asset. Let's figure out what a call option would be worth at the time that it expires. At expiry, an American call option is worth exactly the same as a European option with the same characteristics, because at that point both options provide the identical right but not the obligation, and that is to purchase the stock at the strike price on that last day. If the call is in the money, it is worth the current price of the stock minus the strike price of the option. Your book uses the terminology S sub T minus E, where E is the strike price. Now, in other texts, you may see the letter K used for strike, just like in baseball. Now, if the call is out of the money, it's worthless. To understand why it would be worthless, think about this. If the stock is selling for less than the strike price, would you exercise the option and force the other person to sell the stock to you at the higher strike price? No, you just go ahead and buy it at the market price and let the option expire unexercised. And so the only time this option is going to be of value to you is when the spot price of the stock, or the current price of the stock, is greater than the exercise price. And so we say that C, the value of a call option at expiry, is the maximum of either the current stock price minus the strike or 0, whichever one of those is greater. With options, we like to graph the payoffs and the profits. And you need to be careful when you look at these graphs that you know what you're looking at. For example, this one is a payoff. This is the amount of money that you would receive as a result of exercising this option. Now, this is not the same as the profit, because the payoff chart does not take into account the amount you had to pay for the option up front. And so this is purely the payoff, what happens on the back end. It has nothing to do with what happens on the front end. So what are we looking at here? Well, the option payoff is on the vertical axis, and the stock price is on the horizontal axis. Now, do I even have to tell you that the exercise price of this option is 50? Absolutely not. I could tell by looking at this picture, because we see that the payoff of this option is 0 at 50 and below, and becomes positive after that. So think about exercising this option when the stock is at $60 per share. You would buy the stock for $50 per share from the seller of the option, and then you could immediately turn around and sell it for $60, resulting in a $10 payoff. And that is hopefully what this chart shows. If you exercised at $70 per share, you would have a $20 payoff. So for every dollar the stock price goes up over the strike price, the call option payoff also goes up by $1. Here we have a chart of the profits from holding a call option. Now, this is different than the payoff because it includes the amount we pay for the option up front. That amount is called the option premium, and we can tell from the graph that we must pay $10 for this option up front. We could also see that they wrote that at the bottom of the slide. So that means that at any point up to and including the strike price, my profit for this is minus 10. The amount that I paid for the option. But after that, the profit goes up by $1 for every dollar that the stock price rises above the strike price. Now, the profit for exercising this option is exactly 0 at 60. Why? because the strike price is 50 and the option premium is 10. It takes all the way up to 60 for this to break even. Students often get confused and think, well, then it's not worth exercising the option if the stock price never rises above 60 before expiry. That is not true. Think about this. If the stock price is 55 and I exercise the option, I lose $5. But what happens if I don't exercise the option? I lose $10. And so we know that our loss will be smaller if we exercise if the stock price is above the strike price, even if we don't manage to break even. Now let's talk about put options. Put options give the holder of the option the right, but not the obligation, to sell a given quantity of an asset on or before some time in the future, also known as the expiry date, at prices agreed upon today. That price, once again, would be called the strike price. And when you exercise a put, you are putting the asset to someone. You say, I put the stock to the seller of the option. What would a put option be worth at expiry? Well, at expiry, an American put option is worth exactly the same as a European option with the same characteristics because they give you exactly the same rights on that day. If the put is in the money, meaning that it will give you a positive payoff if you exercise it, then it is worth E, the strike price, minus the current stock price. But if the put is out of the money, it's worthless. And so we say that P, the value of a put option at expiry, is equal to the max of strike price minus stock price, or 0. To see why this is true, let's think about an example. If the stock is currently trading at $20 and I hold a put option that gives me the right but not the obligation to sell the stock at 30, I can force the seller of that option to buy the stock at 30 and then turn around and immediately buy the stock back for 20 if I like. Or conversely, I could buy the stock for 20 and immediately sell it to the seller of the put option for $30, making a $10 profit. But what if the stock is actually trading above the strike price? If the stock was trading at 40, would I want to force someone to buy it from me at 30? No, I'd just go out into the market and sell it for 40 and let the option expire worthless. That's why put options where the stock price is above the strike price are worthless at expiry. Now let's look at the payoff from a put option. Remember that payoffs and profits are not the same thing. Payoffs don't include what you paid up front. They only include the money you receive at the end. So we can see here that payoffs for put options are only positive when the stock price is below the strike price. And for every dollar that the stock price falls below the strike price, the payoff of the option goes up by $1. And so what would the payoff be if the stock price fell all the way down to 0? It's going to be identically equal to the strike price. Is it possible for the stock price to fall lower than 0? Absolutely not. Why? Because corporations have limited liability. This keeps stock prices from falling any lower than 0. So the most a put option will ever pay off is the amount of the strike price. Notice that the potential payoffs for call options, however, were infinite. They have no such ceiling. Here we have the profits from a put option. Notice that the profits above the strike price are at -10. That's because the option premium to purchase this put option was $10. As long as the stock price is at the strike price or above, the profit will be -10. But as soon as the stock price starts to fall below the strike price, the profit increases by $1 for every dollar that the stock price falls. This means that you'll break even at exactly the amount of the premium below the strike price. Now once again, students get confused and they think perhaps they should not exercise the option if the stock price only falls to, say, 45. But think about this. If you don't exercise the option, you lose 10. If you do exercise the option at that point, you only lose 5. So at expiry, it's always optimal to exercise the option, the put option, if the stock price is below the strike price of the option. The value of options comes from two places. First of all, there's the intrinsic value, and that's what we've already talked about. We talked about it in terms of the value on the day the option expired. And the reason we did that is because if we were talking about an earlier point in time, the option would also have what we call speculative value. Speculative value takes into account that the stock price may change before expiry. For example, you could have an option that was currently worth nothing because the stock price was below the exercise price. But because there's a chance that the stock price will go above the exercise price, that option will still have positive value due to the speculative value associated with that probability. We could also see that a put option that had a stock price above the exercise price could still have value because of the chance that the stock price will drop below the exercise price before the date of expiry. As we mentioned before, the seller, otherwise known as the writer of an option, has an obligation. Unlike the buyer or holder of the option, who has a right but not an obligation, the seller has an obligation, and that obligation is to do whatever the buyer of the option decides to do. In other words, if they are called out on a call option, they must sell their stock for the strike price. And if they have a put option that they sold exercise, they must buy the underlying stock at the price agreed to, the strike price. Now, why would anyone allow someone to do that to them? It's because the seller receives the option premium in exchange for taking on this obligation. Let's take a look at the payoffs to selling a call. Remember, payoff just refers to what happens at the end, not the upfront, and so the premium doesn't show up in this call option payoff. The payoff to selling a call option is 0 right up to the strike price. But after that, the payoff drops by $1 for every dollar that the stock price goes above the strike price. This is a mirror image of the payoff from buying an option. Why? Because every dollar lost by one party is a dollar gained by the other. Call options and put options are both what we refer to as zero-sum games. Whatever one party gains, the other party loses. Now let's look at the payoffs to selling put options. If you sell a put option, but the stock price never falls below the strike price, then the payoff is 0. But for every dollar that the stock price falls below the strike price, you lose a dollar. In fact, you could lose as much as the strike price. In other words, if the strike price is $50, you could potentially lose $50. Now, this is actually a benefit on put options. There is a floor to your losses. You'll never lose more than the exercise price. But go back and look at the call option payoffs, and you'll see that your potential losses are infinite. Just like with stocks, you can also get quotes on options. And this is what an option quote looks like. First of all, in the left-hand column, you'll have a most recent stock price for IBM. That's the company, the underlying stock on which these options are being written. And in the next column over, you see the strike price. For the one that we're looking at, the strike price is $135, and the stock is currently trading at $138.25. The next column over tells you when the option expires. In this case, the option expires in July. And then we'll have two columns representing the call options and the put options. And these will contain two pieces of information. The volume is the number of such contracts that were sold today, and the last is the price that the last option sold for. On the put side, we see that the volume was 2,431 contracts sold, and it last sold for 13/16. Now let's take a look at these option prices and see if we can break them down into their intrinsic and speculative portions. Notice that the current stock price is only $3.25 above the strike price, but the call option is going for 4 3/4. That means that the call option is selling for not only the intrinsic value of $3.25, there's also an additional $1.50 in speculative value. Now notice that the put option has no intrinsic value whatsoever. Why? Because the stock price is still above the strike price. However, the price of the put option is still positive. How can that be? Speculative value. That put option has 13/16 speculative value. There's still a chance that the stock price of IBM will fall below $135 before this option expires. Now let's talk about a very important concept called put-call parity. Put-call parity simply says that the value of a put option plus the value of a share of stock is equal to the value of a call option plus a bond for the amount of the strike price. In other words, that bond has a face value for the amount of the strike price and pays off that face value on the expiration date. If you take a look at the green bar, that's the payoff for a call option. The payoff for a bond is 25 regardless of what's going on with the stock price. And if you add those two lines together, you get the portfolio payoff represented by the red line. And that payoff is 25 up to a stock price of 25, and then it gains $1 for every dollar that stock price goes up. That takes care of the right-hand side of the put-call parity equation. Now let's take a look at the left-hand side. Here's the left-hand side of the put-call parity relationship. We're looking at the price of a share of stock, that's the green line, and the payoff from a put option with a strike price of 25. And if you add those two lines together, you'll notice that what we get is a red line that starts at 25 and stays at 25 until we hit the strike price of 25, and then gains $1 for every dollar that the share price goes up. Notice that this line is identical to the line that we graphed for the call option plus the bond with a face value of the strike price that matured at the date of expiry for the option. Therefore, we know that put-call parity holds. The equation is correct. Just in case you couldn't picture them both in your head at the same time, we've got them side by side here. The value of a portfolio composed of the call option plus a bond with face value of strike price that matures on the expiration day of the option, and on the right hand side the value of a put option plus the value of a single share of stock. Notice that the payoffs are identical, therefore they must have identical value today. So far we've only talked about the value of an option at expiry, and so now we're going to talk about what an option would be worth prior to that expiration date. And this is a much more interesting question and requires much more complex mathematics. Here we have the price of an American call option graphed out. Once again, stock price is on the horizontal axis and the option payoff is on the vertical axis. Notice that the intrinsic value here is the green line, but the price of the option is actually higher than that in the market unless we're at the date of expiration. What's the difference? It's the speculative value. That's the value that the option has because the price of the stock might go up before expiration date. This is what's so difficult to value about options, and this is where the complex mathematics will come in. Here we have the Black-Scholes Model. This is the way that we can calculate the value of an option, including the speculative value. The Black-Scholes Model revolutionized the options industry. Until the development of the Black-Scholes Model, we had no way to analytically determine what a call option should be worth, and so it was just the trading in the market that determined this value. But the Black-Scholes Model was the first model to accurately analytically describe the value of a call option. So let's talk about the variables that we have here. You probably recognize C as the value of a call option. That's at time 0, C sub 0. In other words, the present time. R is the risk-free rate, which we would get from 3-month treasury bills. And then we have some other things going on here. For instance, E is the exercise price. D sub 1 is equal to, oh my goodness, what does this contain? Well, we have the stock price, we have the exercise price, we have the risk-free rate, and sigma squared is the variance of returns for the underlying asset, that is, the asset underlying the option. And T there is the time left to expiry. And on the bottom we have the standard deviation of returns for the underlying asset and the square root of the time left to maturity. D sub 2 is equal to D sub 1, which we just calculated, minus the standard deviation of the returns of the underlying asset times the square root of the time left to maturity. Wow! We're not even done yet though, because look back up in the equation. What we're going to do is plug D1 and D2 into the normal distribution, and we're going to get outcomes from there. So what we're really looking at here is a multi-step process that can't be handled easily on a calculator. For one thing, your TI-BA2 Plus doesn't know anything about normal distributions. Now, if this were a class in derivatives, I would ask you to be able to calculate the price of a call option using the Black-Scholes model. But since this is basically a corporate finance class, I won't be asking you to do that. Instead, we're just going to use this model to determine what things will impact the value of a call option and in what direction. Though we haven't shown it here, there's also a version of the Black-Scholes option pricing model for put options. And so the outcomes that we're going to talk about here have been determined looking at those equations. So let's talk about what determines the value of an option. First of all, for a call option, the higher the stock price, the higher the value of the call option. That makes perfect sense because for every dollar the stock price is above the strike price, the call option gains $1 in intrinsic value. And also, even if the stock price is just right below the strike price, then the higher the stock price, the more likely the stock is to become in the money or to have positive intrinsic value. Now it's just the opposite for the put. The higher the stock price is, the less likely it will make it down to the strike price. And if the stock price is lower than the strike price, then that means that for every dollar the stock price goes lower than the strike price, the value of the put option goes up by $1. And so, all else equal, a lower stock price leads to a higher put value option. Or you could look at it the other way, a higher stock price leads to a lower put value. Now let's talk about the exercise price, which I've also been calling the strike price. For a call option, the higher the strike price, the lower the value of the call option. That makes perfect sense because the stock price would have to rise even higher for the call option to become in the money. And once it does become in the money, the higher the exercise price is, the lower the value of the call given the same stock price. It's just the opposite for puts because the higher the exercise price, the more likely the put is to be in the money. And the higher the exercise price is, the higher the profit is given the same stock price for an option that is in the money. Now the interest rate, the risk-free rate, the higher it is, the higher the value of the call option, and the higher it is, the lower the value of the put option. You can see that just from looking at the formulas. And let's talk about volatility and the expiration date. Notice that the higher the volatility of the stock price, the greater the value of both the call and the put options. Why, you might ask? Well, think about this. If you had a stock price that never changed, and you had an option on that stock that was out of the money, would it ever become in the money? Absolutely not. If the stock price stays the same, if there's no volatility in the stock price, there's no chance that stock will ever become in the money. However, the greater the volatility, the greater the probability that the option will become in the money because there's a greater chance that the stock price will exceed the strike price for a call and be lower than the strike price for a put. And finally, there's the expiration date. It has the same effect for both call and put. The longer the time to the expiry of the option, the greater the value. And that makes perfect sense too. If you have only a split second left until the expiration of the option, and the option is out of the money, there's very little time for the option to become in the money. But the longer time you have to maturity, the greater the probability is that the option will be able to go in the money. And so it makes perfect sense that a longer time to expiration will lead to a greater value for both calls and puts. Now, what's the value of a call option? What's the maximum it could ever be? Would you ever pay more than the stock price for a call option on the underlying stock? Absolutely not. We know that we could go out in the market and buy the stock price for S sub 0. So we know that that is the absolute most that a call option could ever bring as far as a price goes. And at the bottom, we know that the lower bound will be the intrinsic value of the option, which is merely the stock price minus the exercise price, or 0, whichever is bigger. Now, the call option value is going to fall somewhere between those two. Why? Because of speculative value. And the precise position of that price of the call option between those two things is going to depend on all those factors that we discussed above. Okay, so you may be wondering to yourself, why in the world are we talking about options in a corporate finance class? Well, first of all, we can look at levered equity as a call option. Remember that levered equity means an equity stake in a company that also has debt. So what's the underlying asset here? Well, it's the assets of the firm. And the strike price of this call option is the amount of money that the equity holders will have to come up with to pay off the bond. If at the maturity of the debt, the assets of the firm are worth more than the amount that it will take to pay off the debt, the shareholders have an in-the-money call. So they'll go ahead and pay the bondholders the amount they owe them and call in the assets of the firm. However, if at the maturity of the debt, the shareholders have an out-of-the-money call, in other words, the assets of the firm are worth less than what it would take to pay off the debt, they won't pay the bondholders. In other words, they'll declare bankruptcy, and they'll let their call option on the firm expire unexercised. We can also look at levered equity as a put option. Once again, the underlying asset is the assets of the firm, and the strike price is the amount that it will take to pay off the debt. If at the maturity of the debt, the assets of the firm are less in value than the debt, then we can think of the shareholders as having an in-the-money put option, and they're going to put the firm to the bondholders. But wait, you say, the bondholders aren't required to buy the assets for the amount of the debt. But in reality, this is what happens, because the money was owed to the bondholders. They should have received some money, but instead they will not be receiving money. So that is how the bondholders pay for the assets of the firm. And in return for that money, they receive the assets of the firm. This is just like a put option where the stock price is below the exercise price. The person that sold the put has to purchase the assets for a price more than they're worth. This is exactly what's going on here. The bondholders are losing more money than the assets they receive are worth. Now, if at the maturity of the debt, the shareholders have an out-of-the-money put, in other words, the assets of the firm are worth more than the amount owed to the debt holders, they will not exercise the option. In other words, they won't declare bankruptcy, and they're going to let that put expire unexercised. So now that we understand the value of the equity position in terms of options, that'll help us to be able to understand some things that go on at corporations, including decisions managers make as far as capital budgeting and in mergers and diversification of the firm. Now we're going to use the new framework we've discovered with options to take a look at some corporate finance decisions. Let's talk about mergers and diversification. A lot of times you'll hear managers use diversification as a justification for a merger. But is that really a good idea? Well, let's look at it from an options perspective. If you remember our earlier discussions on diversification, we know that it reduces risk, and therefore it's going to reduce the volatility of the returns from the firm's assets. Now, if you'll recall, reducing volatility actually reduces the value of an option. Now, that leads us to ask some questions. If we assume that diversification is the only benefit to a merger, is it a good idea? Well, the equity can be viewed as a call option, and diversification is going to reduce the value of that call option because it reduces volatility. What does that mean that a merger that is done purely for diversification will do to the value of the equity? It actually decreases it. So, are managers living out the goal of financial management when they merge simply to diversify the firm? Absolutely not. They're doing the opposite. What does it mean for risk when you do this sort of a merger? Well, you can think of risky debt as risk-free debt minus the value of a put option. And so what's going to happen to the value of that risky debt? Well, let's think about what's going to happen to the value of the put option as volatility decreases. We know that means the value of the put option decreases too. And so risk-free debt minus the put option, that's going to be a greater number now. So the value of the risky debt is actually going to go up as a result of the diversification. That makes perfect sense. The firm is less risky, therefore its debt is safer. People demand less return to hold it. The value of the debt goes up. And so really, a merger that is done purely for the purposes of diversification represents a wealth transfer from the shareholders to the debt holders. Is that good for stockholders? Absolutely not. So what are the conclusions that we draw from the discussion we just had? First of all, mergers for diversification purposes only transfer wealth from the stockholders to the bondholders. That's not good if your goal is to maximize the wealth of the stockholders. Secondly, the standard deviation of returns on the underlying assets is reduced as a result of a diversifying acquisition, and that reduces the option value of the equity. And we'll say it one more time. If management's goal is to maximize stockholder wealth, then mergers for reasons of diversification should not occur. Now I want to throw one more thought in here, and that is shareholders can diversify their portfolios far more easily and far more cheaply than managers of companies ever could. So don't ever accept diversification as a good reason for a merger or acquisition. Let's talk about a counterintuitive thing that can happen as a result of what we know now about options. We have told you over and over again that managers should not accept low or negative NPV projects and pass up high NPV projects. But when might it be optimal for the shareholders for managers to do that? Well, under certain circumstances, you might actually benefit the shareholders by taking on a low or negative NPV project if the firm is highly levered. That gives the equity holders a call option purchased from the debt holders. We've discussed that previously. And that low or negative NPV project causes a substantial increase in the standard deviation of asset returns. Recall that a positive relationship exists between volatility, or standard deviation of returns, and the value of a call option. Well, if the equity of a levered firm is a call option, if we can increase that riskiness or volatility enough of the underlying assets, we can increase the value of that call option. So strangely enough, sometimes taking on a low or negative NPV project, if it's volatile enough, can actually raise the value of the stock, but only if the firm has a large amount of debt. Now conversely, if you're highly levered and you take on a high NPV project that has the effect of reducing the standard deviation of asset returns, that project can actually reduce the value of the call option that the equity holders have at the expense of the bond holders. And so a high NPV project that makes the firm less risky can actually lower the value of the equity position.
One of the criticisms that we see with traditional NPV calculation is that it ignores the flexibility that real-world firms get from taking on projects. In other words, the projects that we take on now not only are standalone projects, but they may give us the option to take on other projects which might have higher NPVs than the current project. In fact, the current project could be a slightly negative NPV, but if it gave us the option to do positive NPV projects down the road, it still might be worth doing. So let's talk about some examples. I have not seen the Saw movies, but surely producing Saw, the first one, gave the producers the option to produce Saw 2. And what if Saw 1 was a negative NPV project, but Saw 2 was a big hit? You couldn't make Saw 2 without making Saw 1. One of the movie trilogies that you may be familiar with, The Lord of the Rings, could not be looked at in this real options framework. And that's because all of those movies were filmed at the same time. So making the first one did not give the option to make the second one because the second one was already made, and so with the third. So if the first movie and the second movie did poorly, it is not as if the producers had the option not to make the third one because it had already been made. Fortunately for those producers, all three were positive NPV projects. The iPhone. The original iPhone wasn't that great. In fact, it kind of sucked. But it gave them the opportunity to make the first one that I bought, which was the iPhone 3G, which was totally amazing. Not compared to what I've got now, because each iPhone gives them the opportunity to make the follow-on iPhone. And the iPhone has now given Apple the opportunity to make the Apple Watch, because the Apple Watch doesn't work without an iPhone. Now, if you've read any reviews on the original Apple Watch, you know that it sucked too. However, I have optimism that Apple will be able to make positive NPV projects out of future Apple Watches.